Hello and welcome to Morningstar. I'm Holly Cook and joining me today is Dan Hambury. He's manager of the River and Mercantile UK Equity Income Fund. Dan, thanks for joining me.
Good morning.
So, in choosing stocks from the universe within UK equity in order to provide that income for your investors, how important is the outlook for the UK economy? Because, of course, it's been quite a strong growth that we've seen relative to other developed countries, but we're still worried about inflation, deflation. How important is that to you in your process?
It is important. We're very much based on stock selection, I guess, like a lot of fund managers. So we do look at macroeconomic risk at a risk management level, and we do that on a sort of quarterly basis. But generally, there is a lot of noise around economics, macroeconomics. Economic growth is often a lagging indicator when you're looking at the stock market. So you have to be a bit careful not to focus on where economic growth is today. You've got to think about the lead indicators about where we are tomorrow. So it was very interesting. If you go back about 3 or 4 years, people used to think about the UK economy as being a bit of a basket case. They were saying you must invest overseas, don't touch anything here. And it's amazing how 4 years on, how we've had a nice recovery. We're finally starting to see some wage inflation coming through. And it's interesting, a lot of the UK domestic stocks, of course, have performed very strongly, including the income-related stocks. So, you know, the general retailers, the leisure stocks, the house builders have all been very, very strong. And actually, we've been taking money off the table in that area over the last few months because in terms of the cyclical areas of the market, it's the domestic cyclicals that have been the strongest. And actually, if anything, the incremental news is more likely to be bad news. Interesting, UK consumer confidence hit a 30-year high only a couple of months ago, and there's a very good piece of research that shows how that, as an economic indicator, is actually very useful, and it's a contrarian indicator actually for the domestic stocks. Now, fortunately, as a lot of people know, there is a lot of international exposure in the UK market, 70% odd of profits coming from overseas. So we're always looking to reallocate capital to really interesting high quality businesses, growth businesses, indeed recovery and asset backed businesses from not just the UK economy but exposed to across the world.
Now, you mentioned a few sectors there, house builders, for example. I know that within the portfolio, you have 30 companies small cap, 30 mid cap, 30 large cap. Is that very deliberate, or do you tend to find sort of better income opportunities in specific sort of capitalisation brackets?
No, I mean, that's not a fixed ratio. That just happens to be where we are now. It's very broadly spread, which is quite unusual. Normally, we would have a portfolio of 60 to 70 stocks, a little bit more focused. And that's when we would typically have a lot of high-quality businesses in the portfolio. But what's interestingly happened over the last 3 or 4 years is that because the high-quality growth segment of the market has done so well, and it was those stocks that have done best for us in our portfolios too, because they've done so well, we've actually now started to reallocate during this year, during 2015, much more to the sort of recovery and asset-backed end of the market. Because they tend to be earlier stage, slightly higher risk, higher reward, we tend to have smaller positions, and we just diversify the portfolio a little bit more in that scenario. So, for example, some of the financials, buying bank stocks for maybe the first time for an income portfolio. There are great yield opportunities in all areas of the market, particularly the mega caps at the moment, and indeed the small caps. We always find great yield opportunities in small cap. There's always great alpha opportunities, but of course there's been very interesting dynamics in the large caps as well, with certain areas of the market being very strong, some of the high yielding companies, but also clearly the cyclical end of the market being very, very weak, and we are looking for opportunities in that area of the market at the moment.
So looking forward in terms of sort of how you're going to go about your everyday business of picking these stocks, what would you say is the sort of main concern or perhaps the main risk on the horizon that sort of keeps you wary?
I think the main risk actually for investors at the moment is to be too worried about the risks. I think we're all so focused on capital preservation because of the global financial crisis, because we've had a sell-off that's been quite aggressive through the third quarter. It's very easy to get very, very defensive at this point in time. And a lot of the indicators we're looking at suggest that there is a lot of fear come back into the market. And there are a lot of parallels, I think, with the 1998 Asian crisis sell-off. And indeed, in terms of the price action, very similar to 2011 when we had a big sell-off in the third quarter. Our view is it's more like those sort of times, and it's not worse than that, that actually a lot of the underlying fundamentals are pretty strong at the moment. We think there is strength in the US economy. We don't necessarily worry too much about some of the slightly weaker indicators we've seen recently. We think there's real strength and wage inflation is coming through. We do expect a rate rise at the end of the year, and we think that's because the economy is picking up quite strongly. I suspect in the UK an interest rate rise will follow sometime in 2016. Similarly on China, there's a lot of bearishness around China. That has a big influence on our market with the resource stocks. and indeed some of the big financial stocks. And again, there we think it's not quite as bad. It's not a foregone conclusion that the slowdown in China is a bubble bursting and it's going to collapse. We think there is an adjustment from those 10% GDP growth rates to 5 or 6%. GDP per capita should improve, but we think there's a wonderful opportunity on a 15 to 20-year view to still buy into EM, and I think you're getting one of those chances in your lifetime, if you like, to get back in on that fantastic growth trend now, because you've had 3 or 4 years of underperformance, and there's real fear in there at the moment. And I think the non-resource related countries like China, India, there's real opportunity there now, and I think if we can get exposure to those through some of the more Asian related stocks, that's really exciting at the moment. Yeah.
Great. Well, Dan Hanbury, thanks very much for sharing your thoughts today.
Thank you.
For Morningstar, I'm Holly Cook. Thanks for watching.